Good day and welcome to the Ibor transition in Euro and Yen. I'm Will Mitting, founder of Acuiti, and on behalf of our hosts, Eurex and Osaka Exchange, it's my pleasure to welcome you today. The transition to risk-free rates and the cessation of most Ibor referenced derivatives contracts has been one of the most significant changes to global derivatives markets in decades. In this webcast, we're going to be looking at how the transition is developing in the Euro and Yen markets. To discuss this, I'm joined today by Kensuke Yasu, General Manager of the Osaka Exchange, Iris Hui, Senior Representative of North Asia FIC Derivatives and Repo Sales at Eurex, Elad Hirschton, Managing Director of Futures First, and Shun Yanagisawa, Director, Japan Head, Futures Clearing and FX PB at Citi. Later on in the discussion, we're also going to be joined by Alexis, a reader in economics and finance at the University of Portsmouth. This webinar will feature two sections. Firstly, a discussion on the transition in Europe and Japan, and then a Q&A with economist Alexis on his views on the outlook for rates markets in Japan and Europe. If you have any questions during the webcast, please file them through the question portal and they'll be answered after the event. I now want to hand over to Iris and Kensuke to give a brief overview of the RFR strategy at their respective exchanges. Kensuke, over to you first.
Hi, thanks very for your kind introduction. I'm more than excited to talk about this topic. I will begin with TONA. Tokyo Overnight Average Rate, TONA, is a risk-free reference rate to replace LIBOR in Japan, which is a volume-weighted average of the rates of all transactions in the JPY unsecured overnight money market. With a permanent suspension of the JPY LIBOR publication at the end of December 2021, the majority of JPY interest rate swaps shifted to TONA-based transactions. In fact, Japan's clearinghouse, JSCC, cleared a notional amount of interest rate swaps based on TONA, recorded the highest number, around 200 trillion yen, or around 1.5 trillion US dollar in March. Interest rate futures based on risk-free rates substituting to LIBOR has been dramatically expanding. As you know, SOFR and SONIA futures have seen significant growth in trading along with the transition from LIBOR and rising interest rates. Unlike the US and the European markets, Japan's interest rate environment is on a different path. Even though the core inflation rate is at a historical high level, 3.1% from the previous year in March, the inflation speed is slower compared to other developed countries. In addition, Japan's yield curve has remained relatively low and less volatile over the past decade, a result of the BOJ's monetary policy to stimulate the economy through a combination of QQE and yield curve controls, YCC. Regardless of how the BOJ's long-term policy shift plays out under the new governor, Ueda-san, it's sure that normalization will start someday, not in the far future, we assume. The normalization path will lead to adequate volatility in Japan's rate markets, and the investors will boost demand for more liquid trading instruments that will enable them to hedge against the risk of higher interest rates, or to take great trading opportunities arising from that volatility. In this context, OSE, Osaka Exchange, decided to launch 3-month TONA futures on May 29th, prior to future changes in the BOJ's monetary policy. The contract is our first ever short-term interest rate futures product on OSE, and our TONA futures will provide another variable tool for hedging and trading amid the normalization process with investors, in addition to existing 10-year JGB futures. We cannot predict when the normalization will occur, but even in the current negative interest rate condition, we had particular trading demand for our 3-month TONA futures from swap dealers, market makers, and hedge funds. Currently, JPY OIS is cleared at both JSCC and LCH, And there is a basis spread between the OIS cleared at the different clearing houses due to the differences in the investor base and demand and supply in each market. OIS's TONA futures could become a great trading tool to acquire these basis spreads. If a highly liquid market is achieved through trading by a wide range of investors, it will provide an appropriate price discovery function for short-term zone Japanese yen interest rates. It may then be possible to observe what expectations investors are forming for short-term interest rates through TONA futures. Well, I should stop here, but I would like to emphasize that we are very much optimistic about the brilliant growth of this market. Thank you, Bill. So back to you.
Thank you, Kensuke. And now we'll pick apart some of those points you made there in the discussion. But Iris, over to you.
Thank you very much, Will. Thank you very much, Yatsu-san. First of all, I would like to introduce myself. I'm Iris from Eurex. I'm responsible for FIC and OTC clearing in North Asia for Eurex. It's my honor to participate in this webinar, and thank you very much for your participation. Back to the topic of risk-free rate, the switch from former short-term interest rate YONA to Esther actually is a part of a border Ibor reform. The ECB began to officially publish Esther on 2nd of October 2019. And Eurex support this transition and started clearing the first Esther OIS in November 2019. That is just 1 month after the ECB published Esther. So complementing this offering with a listed product right now, actually we believe it would further help the market in transitioning smoothly to a new rate. So on 23rd of January this year, Eurex has expanded its interest rate segment by launching the 3-month Eurostar futures, referencing Esther. This launch actually marked a very important milestone in establishing the Esther as a new benchmark risk-free rate and expands Eurex euro-denominated interest rate product offering. With the launch of the 3-month Esther futures, Eurex offers a listed, centrally cleared, and cash-settled solution to both trading and hedging the new risk-free rate. The contracts are based on the compound Esther over a 3-month period and will complement Eurex clearing Esther OIS offering. Eurex is committed to staying the home of Euro yield curve with a highly efficient, fully fungible product portfolio that encompasses the short end and long end across the listed and OTC business. So customer will ultimately benefit from Eurex portfolio-based margin offset across OTC, IRS, and also listed fixed income products. Back to you, Will. This is what I want to say. Thanks.
Thank you very much, Iris. I want to turn first to the Japan transition, and Shun, bring you here in now. Kensuke mentioned that after a period of relatively low volatility, he's expecting a return to volatility in the markets. But what's your current what's the current interest rate market situation in JPY, and where's the volume, and in particular with a look at the swaps market as well?
Okay, thanks, Will, and thanks for the opportunity to speak today. So my name is Shun, Yanagisawa, head of futures, OTC clearing, and FX prime brokerage in Japan. Okay, and then what's the current interest rate market in Japan? So policies at the theater. The grand finale of ex-BOJ Governor Kuroda was with drama. And his successor, Mr. Ueda, first meeting finished without drama. Since the last year, December, the JPY market caught eyes ever in the past 10 years. Mr. Kuroda suddenly changed his policy in 10 years yield curve control bandwidth from 25 basis to 50 basis at the December meetings. Despite the central banks around raising rate through 2022 to combat historic inflation, the BOJ remained on containing the QE, keeping its NIRP negative rate interest policy rate at 0.1, negative 0.1, and continue yield curve control by purchasing 10-year JGBs at the 25 basis, despite OIS market trading at 3x this level. So the BOJ soon find itself to be only the buyer for the YCC eligible JGBs, owning 100% of the market for those issuers. This created significant market discount dysfunctions and kinked yield curves, with the 10-year OIS rallying to an 80 to 100 basis in January. The hedge funds bet the BOJ would abandon the YCC in the March 9 meeting. Then, after the BOJ extended 10-year yield control to swap market, it stabilized around 80 basis in February, following another no actions meeting on April 27th. Overall, the global tightening in fiscal conditions, as well as the Silicon Valley shock and the Credit Suisse crisis, the JPY OIS once again fallen back to 60 basis, no far from the current YCC level of 50 basis. This has a large extent restored the normalization in the yield curve. So during the historic market, the volatility in the 10-year JPY OIS actually higher than the Lehman crisis shock in 2008. In April BOJ's monetary policy meeting, new governor Ueda, a former university professor, announced status quo, including the YCC policy for now, and said they will review monetary policy in 12 to 18 months period. This is longer than the market expectations, but there is a chance to change the policy in June meeting, depending on the U.S. interest rate environment. There are several scenarios, but we think the YCC policy is linked with the U.S. rate hike. If we stop, then continue as is. If continue to raise the rate, adjustment may happen in June meeting. The House view is 2 more 25 basis rate hike in this year. So the next step is observing a situation in the U.S. recessions. Maybe starting in year end, the test inflation, the salary increase in the 2024 spring next year, and decide the commissions of YCC or adjustment or status quo again. In either way, it's matter of the time. I personally think the YCC is not big topic in the market in next year. JPY rates start moving, and once it starts moving, we cannot stop. Thank you.
Interesting. Thanks, Shun. And to look towards the TONA futures, where do you see the demand currently, and how and what do you see as the future demand?
Yeah, so we touch upon the current interest market situations, then the demand for the TONA and the futures. TONA is the risk rate benchmark rate, replace LIBOR. And TONA futures is 3 months futures contract, compounding daily TONA rate, published by BOJ. There are 2 TONA futures market in Japan, TFX and OSE. The TFX one is already launched in March, and OSE one is going to launch in the May 29th. So basically the same contract spec. Although you cannot offset margin between TFX and OSE because the CCP is different. TFX clears through TFX, and OSE one is cleared through the JSCC. So, honestly speaking, the current demand for the TONA futures is not strong yet. We talked about the YCC, 10-year yield control policy, and in addition to the YCC, the BOJ continue NIRP, the negative interest rate policy, which keep policy ratio to negative 10 basis. So we anticipate the easing YCC or abolishment of the YCC in next year, although NIRP policy change may not be a topic of the BOJ yet. So why we need TONA? We need it because the first, and it's futures contract, so the standardized contract, transparent, fast market, and if we have enough liquidity, and the low margin than OTC. And second, the TONA futures have 20 contracts up to 5 years, so you can build a curve. And third, no access limitations. The US persons are not allowed to clear JSCC swaps, due to the CFTC's regulations, which create the so-called LCH JSCC base issue. But futures market have no such limitations. Anyone can join the market. The fourth, the margin offset between the JGB futures and the TONA futures. In addition, you can offset margin with the JPY swaps cleared at the JSCC. And the final point, the TONA futures will be the critical hedging tool once the BOJ modifies the NIRP and the volatility returns to the short end of the yield curve.
Thank you. And finally, how do you see investors using TONA futures?
Okay. First of all, prepare for the short-term interest rate change in JPY market. We don't know that. We don't know when, but need to prepare. Currently, the JPY swaps are mostly cleared at JSCC in the dealer market. It's approximately 90%. And the clients or buy-side access is limited due to the missing of the US persons, which I mentioned before. So it's only 20%-ish. So I'm repeating again, but TONA futures is the easiest way for anyone to the market. And most of us already have access to the OSE and trading JGB futures or the Nikkei futures. Then next step is to take into the margin efficiencies to the consideration of the portfolio, building a portfolio. So as I explained, you can offset margin between TONA futures and the JGB futures. And JSCCs also provide a cross-product margin with the cleared OTC swaps. So this may be the main differentiator of the product. For example, if you have a long or receive the fixed 5-year TONA OIS swaps and the TONA futures, the short positions after the 5 years, your margin requirement reduce 96%. That means only 6% of the original margin required. This is an extreme case, but we don't have, you don't have the liquidity in TONA futures till the 5 years, maybe 2 years, okay, And so you can create a STIR curve by the TONA futures, then 2 to 7 years curve created by the OIS, and 8 years above can be replaced by the JGB futures. So this will provide you the margin efficiencies. Naturally, the futures margin is lower than the swaps, as it's 1.5 days or 2 days value at risk equivalent, and where the OTC is 5 to 7 days in the margin calculations. So to extent that you can use that the futures for the hedging swap portfolio. For example, if you have an OIS curve built up to the 20 years, then you can hedge that duration risk, such as convexity risk or invoice risk, by those futures. The cross-product margins will apply to save your funding cost. So if you want to build asset swaps, cross-product margin will work too. So currently, the market consensus is no change in NIRP. That means there's huge unhedged exposure in the market. This is the fundamental risk, particularly given the recent volatility in the TONA fixing. So looking back my old days, when I studied the futures broker in early 2000, the type Euro N, now it's called the TFX, was one of the main market for a futures broker. There was a huge liquidity in the market. Every day trades thousands of the lots from each client. The market is almost dead since the BOJ introduced the NIRP, but the policy change may happen sooner or later, and the market ecosystem is evolving. So hope you enjoyed my speech, and please feel free to contact me if you have any questions. I'm recording this video from London, but returning to Tokyo next week, but I will be back if you call me. Yeah, thank you.
Thank you very much, Shun. Yeah, and if you do have any questions, please do put them into the question portal, and we will answer them after the webinar. Elad, I want to turn now to Europe. Esther Futures launched in January. How do you see them fitting into the European rates market?
Thanks, Will. First of all, I'll just introduce myself. Hi, everyone, and thanks for having me. My name is Elad Hirchtin. Unlike Shun, I have to introduce my firm too. So I work at Futures First. It's a subsidiary of Hirchtin Group, who's a proprietary trading firm. So sort of where do I see Esther fitting in the European rates market? First of all, in theory, Esther could replace Euribor and Ionia. That's pretty clear. We've seen that in the US, we've seen that in the UK. Because of the fact that there's no plan to get rid of Euribor, nothing that I'm aware of, no regulatory mentioning of this anywhere, Esther could replace Ionia quite simply. But the way I see it, as it could be a very good complementary product for Euribor. And by complementary product, I mean it can create a really interesting complex in Europe, which doesn't exist now, and allow many opportunities for prop groups like us to trade Euribor versus Esther. Now, this is quite an interesting now, especially nowadays, with the banking crisis going on in the US and potentially and in Switzerland, and potentially more to come. There's no better way to express credit risk than this specific trade, Euribor versus Esther. So a IBOR contract versus a risk-free rate contract. So I think it could be a fantastic complementary one. Also, I believe that if Esther 1 is to be launched, not the 3 months, but rather the 1 month contract, which could be somewhat similar to what Fed funds is in the US, this could also allow many more trading opportunities for prop groups such as ourselves. I think the 1 month will give great opportunities, like the 1 month versus 3 months, 1 month versus Euribor, and even include the treasuries, etc.
Interesting. Thank you, Elad. And if you referenced the US market there, obviously that transitioned some time ago. But what have you seen there? Where are the opportunities for firms like yourselves in the US market, and what can we expect as a result? I know you've touched on some of it, but just drawing on lessons from the US, where do you see the opportunity?
So first of all, the transition in the US worked because there was no other option. Because Eurodollar had a final date, and by Eurodollar having a final date and people wanting to hedge the US rate risk, then SOFR became successful by default. What I think is quite unique for the US STIRS short-term interest rate complex is that it is an entire complex. It's not a single product. And by strategies and various, for example, in the US, you have the Fed funds, the SOFR 1, the SOFR 3, and then the active treasury futures, the 10 years, the 5 years, the 10 years, sorry, the 2 years, 5 years, 10 years, 30 years. So there's basically a whole yield curve that you can participate that is very liquid and allows you to do many, many different strategies. I think that's one of the areas where the US has been very successful in, is not just having that single IBOR or risk-free rate future, it's having an entire complex. In general, risk-free rate versus IBOR, I mean, I don't want to fully go into it, but in risk-free rate, you could also basically the same rate hikes or cuts can be expressed in a similar way. From a prop trading point of view, there's pros and cons to both.
Interesting. Thanks for that. And in terms of growing the market, Shun mentioned there's been a relatively quiet start in Japan, and we're going to get the views of Iris and Kensuke on how they'll build liquidity. But what would you like to see? How best to grow the Esther market in Europe?
So again, this is something that I'm not in favor of, but obviously it's a regulatory push. That's clearly the best way to grow it. It's not actually the exchange, any particular exchange doing anything. It's clearly a regulatory push, and there is obviously a lot of interest in liquidity in Euribor. So by that, again, similar to the US, by default, Esther will be a successful product. That being said, if there is no regulatory push, there should be at least a way to persuade swap markets to participate in Esther instead of ONIA. That will create some initial liquidity, and similar things to what I discussed before, where Esther 1 can be launched. I think that will also be a unique thing that Euribor can't fully replace and will just attract liquidity. And if Esther 1 is active, then there's more ways to trade Esther 3 as well. Now, I think another big opportunity for Esther to grow is by listing Esther Euribor spreads. It's a bit complicated with various exchanges being involved, but I think those spreads can be a great opportunity for hedgers and for prop trading firms to participate in, and by that to grow the liquidity in the Esther markets.
That's great. Thanks. Ed. Lots of good ideas there. So to turn over, Iris, I want to come to you first as we're following up on Europe. You heard some ideas from Elad for some product development, and which is obviously in your scope. Regulatory issues, I understand, are outside your remit. But what's the Eurex strategy for growing liquidity?
Okay. Thank you very much for Elad's feedback. The transition to a new risk-free reference rate has been a significant evolution in the short-term rates market and continues to be so. So it will be key for market participants to be equipped with the right tools to facilitate this transition and support a robust development to the new risk-free reference rate. So in this context, the 3-month Euro STR futures act as an additional tool for the market to manage exposure to Esther to assist in cementing it as the key benchmark rate in Europe. We currently have 6 dedicated market makers in 3 months Esther futures, and we are working very closely with them, providing end client feedbacks on pricing quality. And market makers have been very helpful in tightening bid-ask spread whenever possible to facilitate client transactions. So we also have a number of banks ready to provide liquidity in blocks. Our emphasis is to build a healthy and genuine market where volumes from real users and clients can find the liquidity they required. So trade volume in the Esther futures at Eurex has started to increase in recent weeks, and we expect this trend to continue in coming months. And additionally, the Eurex Esther futures are part of the same liquidation group as Euro OTC swap cleared at Eurex clearing and Euro government bond futures, and therefore offer opportunities for margin reduction, which in turn could increase liquidity in this product in longer term as well. Yeah, so thank you very much. Back to you, Will.
Thank you very much. And Kensuke, what's your strategy for liquidity growth in the TONA futures?
So as always, the success of newly launched products depends on grabbing the right timing and getting initial market liquidity to pave the way for a positive market growth cycle. As for timing, investors have enjoyed an ultra-low interest rate environment for decades, but they could enjoy the next wave of opportunities through TONA futures when the BOJ's path to normalization actually starts. As for creating initial market liquidity, OSE prepares several measures and programs. The first point I would like to say is providing easier access to the market. OSE has been providing trading opportunities for 10-year JGB futures, one of the world's most active government bond futures. And global investors dominate a significant presence in the market, over 60% of trading volume. By adding 3-month TONA futures to OSE's lineup, investors can trade long-term and short-term interest rate futures through the same platform for OSE derivatives trading. In addition, TONA futures will be cleared at JSCC, which enable investors to increase margin efficiencies by offsetting exposures with existing JGB derivatives. And moving beyond, for pursuing further margin efficiency, we are preparing to provide cross-margining between 3-month TONA futures and OTC interest rate swaps cleared at JSCC in the first quarter of the next year. This cross-margining will benefit our clearing users even further as they need to manage yen rate risk during important future event. We have received strong interest in the cross-margining scheme from margin-conscious investors and broker-dealers. The second point is harmonizing product specs. The specs of 3-month TONA futures are very similar to CME's 3-month SOFR futures, such as quarterly contract reflecting TONA expectations between IMF dates and the minimum price fluctuation of a quarter basis points. The contract is also available during the same trading hours as JGB futures, so overseas investors can trade during European and US time zones. The third point is securing on-screen market liquidity. In response to strong interest in Japan's rate market, there are around 15 global market makers who are committed to starting to quote on the first trading date of TONA futures. Last but not least, OSE will waive all exchange trading and clearing fees for TONA futures until the end of March 2024. We strongly believe that developing the TONA futures in line with Japan's other rate-related products would enhance the efficiency of the whole rate market ecosystem. Yes, we're back to you.
Thank you very much. And just a final question to Aris and Kensuke. Aris, over to you first on the future environment for interest rate products. What does it look like from your perspective?
Yeah, okay. Actually, the continued increase of base rate by ECB in Europe, combined with the heightened market volatility, has brought attention to the short end of the yield curve. Eurex is continuously evaluating opportunities to make further adjustment in our ESTR offering. As we have already got the Euribor futures and option listed here, the timing of the Esther futures launch has coincided with the increased volatility in the short end of the interest rate market. The 3-month Esther futures is just the first step, and we plan to expand the product suite and functionalities in coming months to further accommodate the market needs. So tentatively this year, Q4, we plan to launch a new inter-product spread functionality between Esther and Euribor and Sharks futures. And we plan to introduce the reduced pricing for stripes, packs, and bundles, and that is potential launch of serial months for Esther futures as well. In 2024, what we are planning is that there may be potential launch of 1-month Esther futures and also potential launch of options on Esther futures as well. So we are collecting market feedback and comments as well. So please stay close to Eurex offering, which may help you in managing your risk, creating trading opportunities, and to increase capital efficiency as well. Because as we said, we have cross-product margining, which can help you to increase your capital efficiency by the initial margin offset between OTC IRS and also the short-term interest rate futures and also the listed futures as well. So if you have any further question, please feel free to reach me out or leave any question in this Q&A session as well. We welcome your question and also feedback so as to improve our service and product offerings. So thank you very much. And back to you, Will.
Thank you very much, Iris. Kensuke, your final thoughts on the future environment for products in Japan.
Yep. So we will just launch this 3-month TONA Futures. So we should more focus on developing this product. But I think the biggest catalyst will be no doubt the BOJ's changes in the monetary policy. Of course, we cannot predict when the change will happen. And the path to normalization could inject much needed volatility into Japanese rate markets, including cash JGBs, OTC swaps, and listed derivatives. So thereby reviving the market function, moving away from fixed yield, and enabling investors to take advantage of structural market moves. 3-month TONA futures will be traded actively with different types of investors under this normalization process, and the success of product could lead to further constellation of additional series of TONA products, such as 1-month TONA futures and options on 3-month TONA futures. On the trading side, as off-screen block trading is commonly utilized for software futures in the US, we are also discussing with the interdealer brokers to provide further off-screen trading solutions with dealers and brokers who trade TONA futures together with OTC interest rate swaps, for example. The scheme will contribute to increasing off-screen matching opportunities, particularly in cases conducting packs and bundles transactions. On the clearing side, as I mentioned earlier, we will offer cross-margining between TONA futures and OIS clear.jcc in the first quarter of next year. Our product launch day is May 29th, next Monday. So the Bloomberg ticker is JOAA. So glancing at the order book or your trading is much appreciated. Feel free to contact me if you have any questions about the products or markets. So thank you very much. So we're back to you.
Thank you very much. And that brings to an end this section of the webinar. We now go over to an interview with Alexis Stemfors, Reader in Economics and Finance at the University of Portsmouth. But I just want to take the opportunity to thank Iris, Kensuke, Elad and Shun for their contribution to what's been a fascinating discussion. Thank you all, and thank you for your time, and thank you for listening. So, welcome, Alexis. So we've just heard about the development of the risk-free rate futures contracts in Japan and Europe. But now let's turn to you for your views as an economist on the outlook for rates. So just from a headline view, what do you see as the outlook for interest rates in Europe and Japan?
Thanks for having me. Well, I think it's sort of, they're very different. On the one side, it's, you know, we're going through exactly the same in Europe as in Japan when it comes to inflation is going higher. We have Ukraine issue is still going on, and there's a string of issues that are similar. But it's quite clear that for Europe, Europe has raised, or the ECB has raised interest rates quite a few times over the last 12 months, and that is probably going to continue for another 3 to 6 months. So we will see even higher rates from the now 375, maybe another 25 or 50 basis points until it sort of stops. Or, and here people disagree. The market thinks this will turn around pretty quickly in 2024. But it's sort of definitely that is where rates are heading. Japan is very different. Japan has, of course, a negative interest rate still, yield curve control. So the 10-year segment is pegged around 0%, and it seems like that is not going to change in the near term. It might change, but the last meeting sort of signaled that there is possibility that this might change in the future, but it's definitely not on the cards anytime soon. So short-term rates will stay low in Japan, and in Europe it just continued to go up.
Interesting. And what factors are driving those rate moves or lack thereof in Europe and Japan?
In Europe is definitely inflation. Inflation is a big problem. The ECB is a fairly strict inflation target, which means that if they don't have inflation under control, they have to raise interest rates by law. There's no discussion here. It's really a matter of, will this inflation stay, or is it just a temporary thing? I think initially most economists believed that this was a temporary shock last year. That started before the invasion of Ukraine, but that was a temporary shock. Now, I think most economists and central bankers realize that this is more serious. So inflation is sort of spreading from initially the commodity prices to food, and there's also higher wage pressure. So that is the main thing in Europe. So if inflation is going to keep going up, or if not coming down, they will continue to hike interest rates. So that is definitely the main thing. And the European economy is sort of decent. It's not a disaster. Europe doesn't have the banking issues as in maybe California, that is sort of causing stress in the financial system. So it's going to be all eyes on the inflation rate. Japan, inflation has gone up, and sort of thankfully, because it has been very low for decades, but it doesn't seem to be enough for the Bank of Japan to change the path. I think what we saw last meeting was that the sort of easing bias was lifted, so they have a fairly neutral stance, but the inflation is just above 2%. The core inflation is not necessarily enough for them to raise interest rates. And we don't see that sort of the economy is still a little bit choppy. So they are not going to rush in raising interest rates. So the more interesting part is the 10-year segment. Will they keep the yield curve control intact? And of course, the band of minus 0.25 plus 0.25 was widened to 50 basis points on each side. And many thought that this was sort of the starting point of maybe removing it altogether, and that was of course a mistake. It was purely to sort of allow the market to sort of regain some liquidity. But surely, I mean, it's trading at the upper end of that band. But as long as that stays, it's hard to see Japanese rates moving much higher.
Interesting. And there's the divergence in inflation that is the key issue, as you point out. Do you expect inflation to continue to rise in Japan? You seem to think it's more embedded in Europe. Is Japan going to see an uptick as well?
It could. I think there are two important things. One is of course wages. Wages have been sort of stubbornly sort of stuck for a very long period of time in Japan. Businesses aren't really keen to raise prices. What is going to be interesting is, of course, the imported inflation. The Japanese yen is incredibly weak and has been so for a long period of time now. And that is sort of, if that continues, it's obvious that inflation is going to pick up. I think the yen is so weak. Now, we've seen a little bit of a rebound in the dollar against the Japanese yen, but that's mainly because of the Federal Reserve or what's going on in the US. But if you look at other exchange rates like sterling yen, Swiss yen, and euro yen, they are still at very high levels. So they're indicating that it's definitely going to be imported inflation coming in.
Interesting. And there's obviously this divergence creates opportunity. Where do you see the opportunity for traders in the current market?
For traders, if I had been sort of back in the markets, I used to trade, your IBOR futures, TIBOR, LIBOR spreads, and what have you, and FX. I think in Europe, definitely I would sort of look at the short-term interest rates. I mean, that is where the opportunities have been during the last 6 to 9 months, and I think still, though that's sort of the most interesting part, is to bet on what ECB is going to do next, and what are we going to do the meeting after. So these various Esther OIS contracts, I don't know how much of an expert you are in the detailed contracts that exist, but it's really about betting on the exact movements by the ECB over the next 6 to 9 months. And I think that's going to be, personally, now of course I'm not a trader, I'm completely independent, but what I see is an interesting segment is we do price in a pretty rapid reversal of these rate hikes in the Eurozone, which means that somehow the market thinks that ECB will continue to raise interest rates and then gradually or pretty quickly turn around and begin to cut. I'm skeptical about that. I'm very skeptical about that. And I sort of putting on my trader mentality, I would sort of go against that, to sort of ride that yield curve, believing that the ECB will not cut rates as quickly as the market thinks. In Japan, it's harder. I think it's very hard. Like traders have sort of started or always bet against the Bank of Japan, sort of saying one day they have to raise interest rates, and I mean we've seen this year as well. I do think though that the segment sort of around 2 to 5 year segment looks interesting, because at the end of the day, I do think that the Bank of Japan will abandon yield curve control. I do think so. Maybe not this year, but sooner or later. And that, I would say, some people say the artificial 10-year point that is sort of due to the Bank of Japan intervention has to be lifted at some point, and I think it will be lifted. And then that segment 2 to 5 years looks way too low on a yield basis.
Interesting. So you're bullish on long-term rates, and how long? At some point you do expect the ECB will have to reduce rates, but how long do you expect rates to be elevated in Europe? And if rates indeed do go up in Japan, as you suggest, what's your time frame before we return to the, I guess, historical average of 3% or thereabouts?
I'm not sure. I actually think this time is different. Like I'm generally a hawk. I'm a hawkish person when it comes to interest rates. So I believe rates are always going to go up. Now, it's been a hard, like it's hard to sort of convince other people. It has been hard because rates have been at 0% for such a long period of time. But I think you have to remember that the ECB is an inflation targeter. They have to target an inflation rate of 2% in 2 years' time. If these rates are going to be embedded in the economy, in inflation expectations going forward, which I think they will, it's going to be very hard for them to cut interest rates. I think so. Japan is different. Japan, of course, since the banking crisis 30 years ago, Japan will definitely not be quick out of the sort of quick in raising interest rates. But I do think that the yield control segment, that policy will be lifted next year, but latest.
Interesting. So great opportunity for traders in the market, and lots of different views and different opinions, which is always good for volatility and opportunity for trading firms.
Yes.
So thank you very much, Alexis, and that brings to an end this webcast. So as mentioned, if you do have any questions, please do put them into the question portal, and they will be answered after the webinar. But thank you to Alexis, and thank you to our earlier panelists, and thank you for listening.
Thank you.